welcome to Gujarati Physicians Convention educational webinar series. Um, we are planning to do year-end tax and estate planning tips for physicians. The goal of Gujarati Medical or Gujarati Physician Convention is to educate our members about the importance of financial planning and becoming financially independent. However, attendees should consult their own advisor and attorney for any advice. This educational event is hosted by Gujarati Physician Convention, and on behalf of committee, me, Gunjan Shukla, and Dr. Sumul Raval are here. We have invited guest speaker Syed Nishat, who will address today mainly tax planning and estate planning. Nishat is a certified financial planner and a certified plan fiduciary advisor. We would like to make this more audience interactive. Therefore, we are not doing a lot of boring presentations. And I'll ask questions simultaneously with Dr. Raval to Nishat, and he will answer. Also, every participant can ask the question in the chat box, and they'll be answered as well. So, Nishat, thanks for coming. And
Thank you, Dr. Shukla and Dr. Raval, for doing it in the short notice. Really appreciate it. Always good to see both of you.
Great. So I'll start with the first question, and then I guess Sumul, you can go with the
Mhm.
second question.
Yeah.
So before we start with the heavy topics like tax planning, let's start with what is the most top financial planning mistake physician do? Nishat.
Yeah. Thank you for the question, and really good to be here. And while we're waiting for more people to come in, some lighter topic, some mistakes I see as a CFP people make. And this is very common for the last 17 years we've been doing it. Is number one, not taking care of your health, mainly not just mental, also physical health as well. Make sure that you always, as a physician, go to your own physician, make sure you're healthy, take care of your mental health as well as necessary. Don't be into the webinar like Dr. Sumul and Dr. Gunjan all the time. Then number two, not updating your will and trust. That's extremely important. Because what we see that the will and trust is very important. They have done it like almost like 10 years, 15 years ago. They are not updating it. So it's very important. Update your will and trust. These documents are important. Investment, a lot of time, Dr. Shukla and Dr. Raval, they make the investments very complicated, like alternative investment, life insurance as an investment. You don't have to do it. You can just buy a plain vanilla ETF or index funds. I always be component of it. And 4 or 5 ETF, you can just play with it. Low cost is hard to beat the market, impossible. If you just do that, I'm telling you in the long run, you're good to go. You don't need to worry about complicated your financial plan. And then a lot of a Gujarati Medical Convention, every time I come, I see they buy a lot of concentrated position. Like this morning, I was talking to a client, they had a lot of NVIDIA and huge NVIDIA. Client called, what is going to happen? I said, I don't know, 50-50 chance. Okay, let's sell it. Earning will be bad. Last time was bad. Okay, fine. We sold it. Client just texted me now upset. They say, stock is up. What is this? So I'm just saying it's not worth it at the end playing all this gamble. If you just buy index fund, don't have a concentrated position like all Nvidia, all PLTR, it's not worth it. Make sure you diversified portfolio. Fees. I'm very big component of paying low fee. And that's what I always advertise. Like there's a mutual fund, there's expense ratio, then you have to pay advisor fee. We did a math. If you pay 1.5% fee on average, advisor plus mutual fund in 10 years, almost 20% goes to the profit to the advisor. So that's very important. Look, take care of your fee as well. And then not enjoying present. This is like what I meant by that. A lot of physicians like have a lot of money, but don't enjoy life. This present moment, try to enjoy if you can. Don't just talk about, children all the time like we used to do, because once you're dead in 48 hours, your children will forget you. That's reality. So try to buy a good car, spend money on yourself because this life is only once. And lastly, not taking care of the financial advisor. Unfortunately, Dr. Sumul, Dr. Gunjanji, what happened that within our community, people do business because we're in the same community, like financial advisor, let's do business. Oh, you're from Gujarat, where? Let's just do business together. But unfortunately, a lot of fraud committed within our own community advisor as well. So it's extremely important that check the background of the financial advisor. Unfortunately, in America, you don't have to be that highly qualified to be a financial advisor. All you need a bachelor's, all you need is like a high school degree and two certifications, Series 766 for a financial advisor. Makes no sense. So make sure they're CFPs. At least they have some level of credentials there, and make sure you do a background check. Go to FINRA, go to SSC. Again, FINRA, SSC, check their background, no complaint. So as long as it's a 7-step process, I say it, you kind of follow it in your life, you'll be a good step ahead of the hype.
That's very useful tips, Nishad, because these are the common mistake that people make. So that's very good information. Now, my question to you is, do you still believe that investors should do passive investment like index funds?
Yes, again, I'm sorry, you go ahead.
So I said they don't need financial advisor for investment only.
Yes, absolutely. So for investment only, I really highly recommend. No one can beat the market at all. I mean, you guys must have heard about Michael Burry. He was touting like, for the last 3 years, I think 26 times he said the market will crash. And recently I see it, he even quit the business. So because he's frustrated. So I'm just saying it is no way you know how to time the market at all. No one knows it. My concern with physician community, like because S&P is concentrated for the last, all you see, 3 years, all the return mainly happened for Nvidia. Every day Nvidia, Apple, Microsoft, Meta. So what I'm seeing physicians are doing, they're buying SPY index fund and they're buying these stocks as well. The portfolio is not become diversifying. That's my concern is. So all I'm requesting, you buy index funds, but what about other index funds? Like buy some international, buy some gold, buy some utility, buy some industrial, Dow Jones Industrial. So make sure you diversify yourself and do not have individual stock. I highly recommend because like over the a weekend, I was meeting with Ajeet Bhai in Florida. So the area, ICC community, the event was happening. The area is booming. And 3 years ago, I went. This year, I was thinking to eat Panera Bread and Buffalo Wild Wings. I have it. I love these two restaurants. I went there. Guess what? Buffalo wings are gone. Panera is gone, but the area is booming. So that's what I'm trying to explain. That area is index funds and Buffalo Wild Chicken, and this is our stocks. So index fund will figure out a way that which stock will go where. Don't worry about it. So just buy the index fund, buy a good area. Don't worry about the restaurant which is buying individual stock. So that's why I highly recommend. Don't need a financial advisor. Buy a few ETF. You're good to go.
All right. Well, uh, let's talk about the current area of the market. It looks like everybody's saying that market may go for a major correction. We haven't had a correction for a while. And tell me how one can protect their asset, which area they should park their money if it goes to major correction, or is it time now to do that?
Right. So a lot of time people ask question, will the market crash tomorrow? The reality is no one knows. I mean, I don't think I know, anyone knows where the market is going to be tomorrow. No idea. So I'm not worried about the market. What I'm worried about is few specific sector, which is the AI sector. I am kind of worried. The reason because what happened, the reason why the market correction is happening, that Sumulji and Gunjanji, there's something called data center. They need
Mhm,
to make it because to run the Chat GPT AI, you need to have a lot of data center chip,
mhm,
and it will run it. So the data center, the budget for America is 3 trillion. The 3 trillion needs to be financed by about 20% down payment, which is 800 billion. That's needed. But tech companies don't have 800 billion. So what they're doing, they're opening up like a special purpose vehicle, SPV. They're opening like a subsidiary of the company, and they're going to private investor like you, SoftBank, other companies, and saying, hey, invest with us, and we raise money from the bank. But the problem is, it is a debt, but the debt is not part of their balance sheet. How long can it last? I mean, something is off in the whole equation. So if it becomes part of the balance sheet, their net income, the net asset will go down. And Sam Altman recently said to Donald Trump, that, listen, why don't you build a data center for us like China is doing it, and we will lease from you? So it is coming out like a bailout. It is like a bank bailout is coming out, and that's why the market is falling. And anytime Nvidia, those stock goes down, is bringing the whole market down. So in our opinion, the second question you asked, which sector to invest? My suggestion would be soften down AI a little bit, get into the sector like construction sector a little bit because they are the one will go higher. Go international. Look at my chart in the screen. If you see the next 5 years projection, the international market we are predicting to go much higher than America. So get into international about 15% of the portfolio. Get into the construction sector, get into the energy sector, less a little bit into this AI sector because those and utility sector, these sectors will go higher. And how to invest in this market? It's not complicated. Listen, if your net worth is you need in America 6 million to have a comfortable life at the age of 66. That's the reality. 6 million, 66. If your net worth below 6 million, be conservative. It's a screen right there between 50% equity, 50% bonds. That's it. If your net worth 6 to 10 million, moderate. 70% equity, 30% bonds. If your net worth is more than 10 million, if the market even goes down 20%, doesn't matter, the net worth will be more than 6 million, you should be growth. And if someone like 40, we have a long way to go, you should be aggressive growth. So you can play with few index funds, just choose the allocation. But if you need the money in less than 5 years, you should never invest in the stock market, first of all, to begin with. So as long as you have this time horizon, your net worth is there, choose these four models is in front of you, have 4 or 5 ETFs and play with it, you're good to go. Don't time the market. Hopefully, it makes a little bit more sense.
Thanks. So going back to the tax planning, what are the major changes in this big beautiful bill in terms of tax and estate planning?
Yeah, just few pointers. If possible, the big beautiful bill recently been passed. If possible, try to have your income below 500,000. When Donald Trump was president, is president now, the maximum state and local tax deduction. Remember, New Jersey, 10,000. Both of you, New Jersey. But if your income somehow, if you can work less or have some deduction, bring it down to 500,000. The state and local tax deduction is 40,000, which is decent, property tax, decent. So try to work less or have more deduction by December, if it's possible. 401k, contribute more. We'll talk more about it in the subsequent slide. Number two, Trump account. Don't forget, if the audience who's listening, if you have grandchildren, if your child is born this year, government's giving you $1,000. Claim it by December. Plus, you can put $5,000 for the Trump account as well. And number three, if you need a bigger car, this is a good year to go do so because the car weigh more than 6,000 pounds. You can write off the full purchase price of the car from the business. All right, this is a good year to do so. And lastly, for estate tax purposes, we don't have to worry about estate tax too much unless your net worth more than 30 million. Because what happened up to 30 million is the law passed, there's no estate taxes. So my suggestion will be just focus on something called revocable trust. That's it. Irrevocable is not important. Revocable trust created. You create a revocable trust, you fund it, the house, brokerage account. The benefit is if anything happens to you, nothing goes through probate. Anything happens to you, the children get into marriage, divorce, all protected. So do focus on revocable trust. Irrevocable trust, only focus if your net worth is more than 30 million.
I see. Okay, so it looks like irrevocable trust is not the important at this time. But what if our net worth is over 30 million? And what are some solutions to lower estate taxes?
Yeah, so just in case if your net worth is more than 30 million or close to the vicinity, you have to pay state tax regardless, right? At that time, what you can do is these are the few things before year end. You don't have, because you can do that. So gift annually $19,000 per person, husband, wife, 38,000 per child. So I was I was meeting a client in New Jersey, husband, wife, two beautiful daughter, four grandkids. We did the math, $19,000 times two times six, almost about close to the vicinity of 220,000 per year. He can just put away, and the money is out of state. All right. Number one, by December you can do that. Number two, on top of this, like for example, my two children are going to private school, Noah and Ayan. In Eunice, I previously jokingly said my mother-in-law is very rich, so her net worth is very high. And what she's doing, she's paying the tuition directly for my kids. So that is on top of the 19,000. All right. So that's perfectly on top of his money is out of our state as well. And then after doing that, even you still have some more money, create irrevocable trust, like I mentioned. In an irrevocable trust is a type of irrevocable trust called SLAT, SLAT, Spousal Lifetime Access Trust. You can gift $15 million each, 30 million. And once you gift it, the money grows out of the state. Again, very powerful. Only if your net worth is more than 20 million, you can think about doing SLAT, but wait for the market to drop. If the market drop, the asset value will be down, then gift it at that time. Hopefully, this kind of solidified when to use revocable, when to use irrevocable.
So as a CFP, can you explain what estimated tax are and how they work?
Yeah, so by December, so now we're talking about tax planning. By December, January 15, you do have to pay all the estimated taxes for 2025. Don't forget though. So there's a safe harbor rule, 110% of last year or 90% of this year. You do have to pay. If you don't pay, there's a penalty. So just sit down with your CPA. If your income is a lot this year, you may want to pay all the estimated taxes right now. So again, remember the safe harbor rule formula, 110% last year or 90% of this year. Don't forget to pay the estimated taxes. We see a lot of people think, hey, taxes are due in April. No, no, no. Your estimated tax is due now. You have penalty due, by the way. So those don't forget it.
Okay. So what is RMD, required minimum distribution, to lower taxes?
Yeah. So required minimum distribution by December, if you're over the age of 73. First time there's some more rules, but by December, usually you do have to take RMD or required minimum distribution. Usually the amount is whatever the value divide by like 21 or about 4% the value it comes out to be. A few things you can do. If you're charity minded, like if you want to give to, let's say, Gujarati convention, this year, 110,000 you can give directly from the retirement account to Gujarati convention and that take care of your 110,000 RMD. All right, one option. Second thing you can do is do something called a Roth conversion, which is very powerful by December if you want to do it. Because if you do a Roth conversion, the money becomes Roth IRA, and in the Roth IRA, there's no RMD. Now you might be saying that, by the way, if I do a Roth conversion, I have to pay taxes. So I just want to take 1 minute to explain. If you do a lot of Roth conversion, think about doing a foundation at that time, a type of foundation called charitable lead trust. How does it work? Let's say you have $1 million IRA account. You decided to do a Roth conversion this year. 1 million you convert, 400,000 taxes due. But in the same time, you open up this charitable lead trust, a foundation, you contribute money, 1 million into it. Net is zero because what happened is a conversion happened and it's an expense. Simple, right? But the charitable lead trust, what happened, don't have to give it to charity right away. It's a schedule, 5% every year. 5% every year, 20 years, all the money goes to charity. You can invest the money, buy SPY, and the return, let's say, is 10%. So whatever the growth goes back to your family tax free. All right. So very, very powerful. If you're charity minded, you have cash sitting in the bank, do a Roth conversion, and at the same time decouple it with this foundation, and you have like a tax-free retirement account is very powerful. And lastly, if you're lucky enough to have your spouse 10 years younger than you, then what happened that you don't have to take RMD on your age. It is much lower. It is on the joint spouse age. So these are a few quick tips before year end. Talk to your CPA about it.
So then, what is the difference between donor advised fund and a private foundation like you mentioned?
Yeah. So the donor advice one, what happened? There is no attorney needed. You can do the same thing. All right. So you can do a Roth conversion, put the money into a donor advised fund. But what happened? The max you can do for tax write-off purpose, 30% adjusted gross income, anything over basically kind of flows through for the next 5 years. But in donor advised fund, there's no attorney, nothing, but all the money for donation. Nothing goes back to your family. Charitable lead trust in 20 years goes back to your family. That's the only difference. And there's a lawyer involved. That's it.
I see. So a lot of my friend and physicians who invest in real estate. So what is the cost segregation for real estate?
Yeah. So cost segregation, what happened, a lot of physician and my most of my clients, especially who are Gujarati, invest into motel business and invest into real estate. So what happened then, the reason why they do that is because of mainly depreciation. So for a $1 million property, what happened in 39 years, it depreciate becomes zero. You can get to write off. But the schedule is up to you. You can bring down from 39 years to 1 year, all of it if you want to. In $1 million, because of the big beautiful bill, almost about 400,000 nowadays government is giving an advanced depreciation. The whole study is called cost segregation, whole study. So how does it work? So if you have other rental income, you have $1 million property, up to 400,000 for $1 million, you will pay no taxes. Again, very powerful. By December, you have to start the process. So if you have a lot of real estate, a lot of rental income, speak to your CPA, but cost segregation must start by December.
That is very, this cost segregation is extremely useful tool.
Yeah.
Now coming to the next question, what is the state PTE tax? How does it work?
Yeah. So remember, Sumalji and Gunjanji, we spoke about the state and local tax. You remember 10,000? If you have
Yeah.
your own company, by the way, if you have your own corporation, and if it's a S corporation or multi-member LLC, instead of paying the individual taxes, they only get only 10,000. And let's say your income is high, nothing you can do. If you have your own corporation, you pay the same state tax from the corporation by December. All of it you have to pay by December, by the way. You get full write-off federally. Again, you get full write-off federally. So let's say you owe $40,000 state tax, but your income is high. The only thing you will get is 10,000. Okay, I will pay 40,000 from the corporation, all of it by December. So from your K1, your the company, the income will be 40,000 less. It's very, very powerful. By December, you need to do it. Okay, so that's why we're talking about last moment tax planning tips.
I see. So if I'm selling my practice, what is goodwill versus asset sale?
Yeah, unfortunately, the reimbursements are going down, Sumalji and Gunjanji. Cardiology is the worst, I would say. And oncology is doing fine. Psychiatry is doing very fine. But I think that other internal medicine reimbursements that everyone is saying going down, unfortunately. So a lot of physicians are selling their practice to big hedge funds and hospitals as well. All right. So when you're selling it, try to negotiate goodwill. Goodwill means like Dr. Sumul Raval, if I Google you, you are amazing. So many good reviews. Gunjanji, you are like, out of the chart. Like if I Google you, like 5-star review. So because of you, patient comes. So that's called goodwill. So when, let's say, for example, you're selling it, try to get about 70-80% of the selling price as a goodwill. Why? Because if the sell is goodwill, on, let's say, for $1 million you sell is doing 700,000 goodwill. On the 700,000 you will pay long-term capital gain, which is 20%, versus the whole amount is like a regular income. So try to add goodwill in it if possible.
I see. So what is QBI and why this is important?
Yeah, QBI, this is a lot of physicians miss out, is qualified business income deduction. And a lot of physicians says, they don't even know about it. So QBI is there's for real estate. QBI is for personal income as well, self-employed. So self-employed physician, if your income is close to 496,000, below that, you qualify. You qualify all of it pretty much if your income starts with below like 350 pretty much, but it start to phase out and 496 completely phase out. So if it's possible, try to be in the range. How does QBI work? Let's say your income, business income is $200,000 from the LLC. You can write off 20% of 200,000, 40,000 as a business expense. Again, it needs to be below the income limit. So what financial advisor CPA does, they sit down with you and see what can we do? Charity, donation, business expenses to try to bring the income down. So, but all of this needs to be done by December, so you qualify for QBI. All right. So again, self-employed physician, QBI. Real estate professional, what happened? There's no income limit. Whatever the rental income comes in, you can write off 20% of the rent as a deduction as well. So don't forget QBI is very powerful.
I see. So if I'm self-employed or doing locum, which are many physicians do nowadays, how to decide whether I should form LLC, S corp versus C corp?
Yeah. So this is a lot of confusion I see, and a lot of physician, Sumulji and Gunjanji, I see that they are just sole proprietorship. That's like LLC, no S corporation. What to do, when to do it is very confusing. A lot of opinion. If your income is below 100, LLC, just kind of memorize it. You know, and if your income is more than 200, 150, 200, S corp. Why? Because what happened that if is an LLC, let's say you put the money into a LLC, like Wall Street Alliance Group, you see it, you get income put into Wall Street Alliance Group, and you take the money out as a distribution. The whole money you pay 4% Medicare tax plus Social Security tax, right? If it's an S corp, and let's say my income is 200,000, what I could have done, I could take 100,000 as a salary, W2, and the other 100,000 I can take as a K1 distribution. What's the benefit? The K1 distribution, I don't pay the 4% tax.
Mhm.
So the ratio got to be there. An S corporation a little bit expensive, LLC is cheap. So again, less than 100 LLC, close to 200 S corp. That's the way to go. And S corp, you have the SALT PTET. LLC, you don't have PTET single member. So that's why it's important. How much is your income? Don't forget, if your income is 500,000, hey, don't do LLC, do S corp. Sit down with your CPA about this. C corporation most of the time doesn't make sense. So these two are very important. Sit down with your CPA before year end. Don't forget.
Okay. So you mentioned earlier about some Roth conversion. Is it a good idea to do so this year?
Yeah. So Roth conversion, unless like you're a bad investor, the market is high. It's not a good year. Like you got to be a very bad investor, the market for it to go down, right? So Roth conversion makes sense if you're in a low tax bracket and if the market is down also. Both gotta happen. So if for some reason you're in a very low tax bracket and your income will go high next year, yeah, Roth conversion makes sense. And then what happened? That money becomes tax free, but that needs to be done by December, right? And then if the market, let's say, goes down, whenever, let's say by December market goes down, that's a good time to do a Roth conversion as well. My suggestion is don't go all in. At least every year, try to do some Roth conversion, at least 5 to 10% of the value. The reason is because the money becomes tax free when you take it out. So a Roth conversion, I think a percentage every year you should do it.
Thank you.
Okay, Nishad, I have heard about land easement or conservation. Is it worth it?
Yeah. So what happened? Remember the donation you do, you get deduction. There's something called land easement, land conservation. What happened once you put money into it, you have to forget about this money, but the you get 4 time deduction. So if you put $100,000, you get $400,000 deduction. The problem is like everyone misuse it. Like so IRS audit happens a lot. So it could make an argument can be made, but we see a lot of IRS audit. So that's why everyone asks about us. We are warning them, make sure you speak to the CPA about the IRS audit because of the huge deduction you're taking. So it's a red flag. We see it most of the time. Be very careful.
That's very nice to know. Now, this is my last question to you, Nishad. Can you please list all the items and summarize last minute tax planning tips?
Yeah, that's for the audience. Hopefully, you can just take a picture of it. This is like I just type everything what I can humanly think of. So in this way, what happened? They don't miss nothing. So number one, pay estimated taxes. We spoke about it. Number two, try to get your income down below $500,000 because what happened? You get the state and local tax deduction 40,000, 19,000 gift per children per parent. Don't forget before December, money is out of your state. If your net worth like high like my mother-in-law, pay the tuition of the grandkids out of your state, on top of the 19,000. Trump account, don't forget Trump account. That money $5,000 you can put in, that is on top of the 5 to 9. QBI, don't forget about QBI. If you need a bigger car and the car may weigh more than 6,000 pounds, this is a good year to do so because you can write off the full purchase price of the business. We spoke about cost segregation. So cost segregation is very good idea to do so if you own real estate. This is something I think is fun to do it. If you have children, Sumalji, Gunjanji, if you have your own corporation, it may not be a bad idea to put them in payroll. Make them work though. I mean, don't just give them money. And then what happened is pay them like, $5,000, $10,000. They can open up a Roth IRA and then a low tax bracket. That's also a lot of people miss out. Very good things to do. Charitable private foundation or donor advised fund, by December you have to do it. After December you cannot. Backdoor Roth IRA and Roth conversion, remember, depending on your tax bracket, do so by December. Tax loss harvesting. So if you have some stock, let's say, for example, PLTR, if you bought it into a high price, I'm giving an example, it's down, sell it, buy something similar with the money. What happened, the loss you can carry forward, and you can get to write off from the other income as well. So tax loss harvesting is very important. Speak to your financial advisor about it. That's one of the big advantage of using financial advisor. And then Gunjanji, Sumalji, if you nowadays, I think you're getting email from your hospital if you work. The benefit, choose the benefit.
Yeah.
If you're getting that, choose HSA for health insurance if you can. In a HSA account, you can contribute about $8,700, and it's pre-tax. Very powerful. It's a triple tax exempt. After the age of 66, you can use the money for non-health reason as well. And most of the physicians don't go to physician. They just take, do their own treatment. So my recommendation, do the HSA. And lastly, defined benefit plan. So if your income is a lot, by December, adopt a defined benefit plan. You can adopt later, but by December is better. So you have the correct data. In a defined benefit plan, it's a pension plan. You can contribute like almost $200,000 over the age of 52, and all money is pretty much tax deferred. So hopefully this is like a good kind of lists, and sit down with your CPA before December 31st, because after that, nothing much you can do, and see which one is applicable for you.
No, that's really, these are the kind of very important bullet points that you mentioned, Nishat, but uh, we had the last minute this webinar, so not many people were able to take the advantage of this. One last question. With this HSA account, if you're in a private group, like a private practice on your own, can you set up the HSA account for yourself?
Yes. Sorry, can you hear me now?
Yeah, I can hear you.
Yeah, absolutely. So, and then it's like there's a couple of questions I see if you want to ask, I guess.
Yeah.
Yeah.
So one of the question, it says, can you do both HSA and regular insurance?
No. So HSA account, is by the hospital. So just choose one. I'm talking about, health insurance. Yeah, choose one.
Okay.
Okay.
Um,
Any other questions from audience? Please type up here in Q&A so we can ask Nishat before we conclude our webinar. If there's any, because he already mentioned so many important tips and information. I'm sure you guys learn a lot today. So if there's any last minute questions anybody has, please put up in Q&A says.
so in the meantime, I'm going to ask Nishat one question. If you put your children on the payroll, how do you show the government? Because I believe in the family member, you don't have to do payroll. So how do you show that they made money to put it in the Roth IRA?
No, so you gave them salary. You gave them salary. So what I mean by that, if you have your own corporation, we're talking about own corporation. And then what happened that, let's say you need to have some Schedule C income though, Schedule C, some 1099 income. From the 1099 income, you give them a salary of 5,000 each. You do have to pay the payroll tax, but it's still their net income tax is very low. And if they have earned income, 5,000, their earned income, I'm giving example, they're eligible to open up a Roth IRA for themselves, which is very powerful, goes tax free.
Mm-hmm.
Yeah.
Okay.
There is another question, is that life insurance for estate planning. Is it a question or?
I guess someone asking, yes, life insurance for estate planning is a good idea. Yeah. I think I didn't cover all of it. Advanced topic. Yes, you can buy second to die life insurance policy for estate planning purposes if your net worth is significant and the life insurance can pay for the death benefit. Make sure the life insurance is owned by an irrevocable trust, so the death benefit is out of your state.
So Dr. Parikh asked the last question about what are the kind of estimated costs in different things that I know it's a kind of very wide question, but what is the cost involved?
Yeah, so a revocable trust is around $3,500 to $4,000 to set it up. Irrevocable trust is the same. Every time the word trust comes in is $4,000. Revocable 4,000, irrevocable 4,000. ILET another 2,500 to 4,000, depending on what kind of ILET do you need. And then if you do investment, there is a management fee. Every advisor charges like us. So our fee 1 million is up to 1 million, 1% over 1 million point nine, and it's a tier basis 2 million point eight. But the question you do have to ask, is it worth it paying all the fee? Usually our clients they have like a lot of needs, state planning, tax planning, and all of it. Is the question is, do you need all of this? And then only come to us.
I see. So Jagdish is asking, with the market is all-time high and we cannot time the market, would you still recommend investing in an index fund? And if you do, then do you have some ideas?
Yeah, I do still recommend do something called dollar cost average if you have money laying in the account and you don't need the money. Question is, do you need the money? If you need the money, don't invest in less than 5 years. I speak at the very beginning. But if you don't need the money, my suggestion, don't time it. Market high, market low. In the long run, it will go high. Do a dollar cost average. Like right now, market is down for the 6% down from the top. Hey, it's a good time to do a dollar cost average. Now, the specific fund, what happened that if I say it and this is recorded, Gujarati Medical will be in big liability. So that's why Ajit Bhai and Sumulji and Gunjanti, they don't want me to say it.
I see. So Dr. Geeta Patel asks, do you recommend a revocable trust even if your asset is less than 5 million?
Oh yes, revocable trust is mainly about not about uh, um, assets. What how big size of the assets are is what kind of assets do you have? If you have children, if you have asset outside the state, the main purpose of avoiding probate, even if your net worth is, let's say, I'm just talking about $500,000, the probate costs significant amount of money. So if you have, let's say, a couple of small houses, some brokerage account, guardianship, it's a small cost. I highly recommend will is a must, power of attorney is a must, trust also get it done. It's a small cost.
Okay. So other question, I actually know the answer, but I'll let you. What should you, when should you do the estate planning? And is there a deadline open before December or not?
You can do the estate planning as soon as possible, as depending on your situation, though. Okay, you sit down. Like if you have no kids, single person, I mean, doesn't matter. But I would like to see you have a house, you have a family, you have children, you have some assets, some like segregated assets to get the basic state planning done.
Okay. So my friend Dr. Parikh just texted me asking, what is the cost? You explained that in detail, but can you just tell very briefly what is cost segregation?
Yes. So cost segregation is if you have real estate, so the real estate basically depreciates every year. There's a schedule. Residential is 29 years, commercial is 39 years. So let's say you have a commercial property and it is 39-year depreciation. 39-year means if you do the math, 2.5%, 40, that's 100% depreciation, ballpark, right? So $1 million, what happened if you don't do anything? Around close to 2.5% of 1 million depreciates every year. 25,000, 25,000. So if your rental income is 30, 25,000 depreciation, 5,000 you make income. Simple, right? But the schedule is up to you. If you think, hey, this year my income, these are my highest income bracket. I don't want to pay taxes. This property is for long term. You know what? I will do the advanced depreciation. The 1 million, I will do 400,000 advanced depreciation in one shot. That is called cost segregation. Cost segregated. Bring it down, bring it back. That's the whole study. The cost of doing that is about $3,000 to $4,000, depending how big is the property. So the 400,000, what happened? Any other rental income you collect, you pay no taxes in it. The property cost goes down because you depreciate in advance, but you're doing it for long term anyway. So all okay, all kosher. So if you want to like lower the tax bracket, which you're high right now, in the future it will go down. Cost segregation for real estate is very powerful.
Yes, that makes sense. The question from Dr. Sunita Polipali, how much life insurance should you buy for estate planning? And what about buying 20-year term or 25-year term for estate planning since it is so much cheaper?
Yeah, so term for estate planning, it doesn't, I don't recommend because when will you die? You don't know it, right? So term life expires after a certain age, and you may live 100 years. Longevity is going higher. So term doesn't make sense. Universal life makes a lot of sense to do it. But if you don't have money, what you can do, you can buy term life with the rider to convert into a whole life any given time. Your health will be locked. That could be one option. Now, how much life insurance to buy? Someone needs to do the manual calculation. Someone to do the projection. Okay, do you have 10 million, 7% growth happen? If you live that long, I mean, they're gonna ask the question, how, your grandmother, father, are they alive? Answer is yes, that means you're gonna most likely live longer. All right, do the projection, what the projection looks like. Based off of that, they create like this, they recommend life insurance.
Yeah. Okay. Any last questions from the audience?
I think we are good for the questions. So
Yeah, so I think this point we will just want to thank. This is actually went more than time that Nisat initially gave us for this, but because of so many interesting questions, he continued to explain more. So we want to thank Gujarati Physician Convention team, thank Nisad Syed, our CFA, our CPFA, BFA, our financial guy, our advisor, our every confusion remover, and our biggest sponsor for the Gujarati Physician Convention. So we want to thank him for his continued support. More importantly, we thank him for giving us correct advice and leading to a lot of important investments and decisions. Kevin Shah, also want to thank him because he is a part of this team. And I want to thank entire Wall Street Alliance Group for their continued support for Gujarati Physicians Convention team.
Yeah, thank you very much, Dr. Shukla, Dr. Raval. And the recording will be there. Feel free to share whenever you can.
yeah, so I want to tell everybody that this thing is recorded, and once we get the recording, we'll distribute it to all of our people so you can review it again. And if you have any questions, I think the numbers would be there, and you can call Nishat or Kevin. Okay.
Thank you very much, Dr. Shukla, Dr. Raval. Really appreciate it. Thank you, everyone, for joining.
Thank you. Thank you.
you.
Good night.